Distribution dividend coverage, why it's important, and what investors need to know. This article was written by Stephen Bavaria. Distribution coverage sounds very important and critical. So, what is it? It involves identifying the cash flow sources of distributions from different types of closed end funds and how stable and predictable those sources appear to be. Credit funds and equity funds have very different sources of distributions, some very stable and predictable, others more volatile. Credit funds rely on business as usual income, aka net investment income. Equity funds rely on capital gains, which are far less predictable. Guess which one allows many income investors to sleep better at night? When I first introduced the income factory here on Seeking Alpha, I was called a heretic. Now, thousands of my readers describe how they sleep better at night through market downturns. Distribution coverage. What does it mean? One of the issues that comes up a lot and generates many questions is the whole topic of distribution sources. Especially, where do our funds' distributions, i.e., dividends, come from, and how do we judge their dependability and reliability? One term we often hear in connection with this is distribution coverage. Distribution coverage, in general, refers to a fund's ongoing ability to support or cover its current distribution from its various sources of cash and/or other income. Closed-end funds have essentially two ways of generating income. The fund earns dividends and interest from its portfolio of stocks, bonds, and other securities. And some funds make capital gains from increases in the market value of their portfolio of stocks and bonds, and capital losses when the market value of its portfolio decreases. As we shall see, some funds rely almost entirely on the dividends and interest they receive from their investments in sourcing their own distributions. Others rely almost exclusively on their capital gains to do so. As we shall see, cash interest and dividends that a fund receives from its own investments are generally a more stable, predictable, and reliable source of cash with which to pay distributions, as opposed to capital gains, which can be much more volatile. 1. I call the first one dividends and interest, a fund's business as usual income. That's the cash that comes in day after day, week after week, from the stocks, bonds, and other securities that a fund owns, as long as they make their regular dividend and interest payments. This payment stream tends to remain largely the same, regardless of whether the market prices of the stocks, bonds, or other securities that make those payments go up or down. In financial parlance, this business-as-usual income is called net investment income, or NII, and it's defined specifically as the income received from the securities a fund owns, minus all the expenses of running the fund. The NII of a fund, divided by the cash amount of the distributions it pays, is often called the NII coverage ratio. CEF data, a good source for earnings and other data on both closed-end funds and business development companies, BDCs, calls it earnings coverage and lists it under earnings down on the left side of each fund or BDC's page. Here's an example F from CEF data. A new business development company called Nuveen Churchill Direct Lending Corp., NCDL, established just last January. As a BDC, the firm makes mostly senior secured corporate loans, so its income is primarily interest and therefore of the business as usual type, or NII. If we look down the left side of the CEF data page for NCDL, we'll see under the earnings heading that NCDL has 129% earnings coverage of its 10.5% distribution. So even though it's a new company without much of a track record yet, although its sponsors Churchill and Nuveen are old pros at corporate lending and closed-end fund management, investors know that NCDL has its current distribution well covered with steady cash flow, and also sells at a nice 5% discount. Calling NII business as usual income is not to say that dividends and interest payments never go down, but it's not a normal occurrence, the way market prices change routinely on an hour-to-hour basis. The second source of income listed above, capital gains, is a less predictable source of income, but an equally important, or even more important one, for certain funds, particularly those that have low dividend yields or little or no interest income, i.e., most equity funds. It's easy to summarize the difference between the two basic types of fund income: net investment income, NEI, interest and dividends that flow in regularly, regardless of market price gyrations, slow and steady like the tortoise in the proverbial race. Capital gains, which are great when you get them, but are harder to project and predict with any specificity, more like betting on the hare rather than the tortoise. Once we understand the difference between slow and steady net investment income and less predictable and more uncertain capital gains, then we can begin to evaluate and appreciate the inherent differences between various types of funds. The two main categories of asset classes that I buy for my personal portfolio and that we hold in our remote for inside the income factory model portfolios are 1. Credit funds that hold fixed assets, which in our case are mostly credit assets like corporate loans and high yield bonds. Corporate loans are senior, secured, floating rate debt that sits at the top of the corporate capital structure. Its holders are paid first before any other creditors or stockholders get paid in the event of a corporate default. High yield bonds are unsecured corporate debt, sitting just under the loans on the corporate balance sheet, but still above the stockholders. Equity. So both loans and bonds have to be paid in full before the equity holders are entitled to any payment in the event of default or bankruptcy. This is a big deal because even when loans or bonds default, the holders generally collect back at least 40 to 50% of the principal, bondholders, with secured loan investors collecting 60 to 70%. Loan and bond investors get paid interest regularly, at interest rates typically in the high single digits or even low double digits, depending on the credit quality of the borrower. And at maturity, they get repaid their principal at 100% of par, unless the company defaults or bankrupts. As an investor, typically I'm happy to just receive my 9 to 10% per annum interest, plus my original principal back at maturity, and would regard any capital gain as icing on the cake, but hardly to be expected. Although smart fund managers sometimes achieve capital gains if they can purchase some of their loans or bonds at a discount in the market and then collect 100% at maturity, this is more likely to happen during volatile credit periods when even healthy loans and bonds get traded down, i.e., discounted, in the secondary market. From a distribution coverage standpoint, the key point about credit funds is that most of them earn virtually all of their income in the form of regular interest payments, i.e., business as usual income, that come in more or less like clockwork, regardless of what's happening to market prices. In other words, the bulk of their income is net investment income, NII. So NII coverage of their distributions tends to be relatively high, generally close to 100% or even above 100%. And when NII covers 100% of a fund's distribution, it means the fund isn't dependent on capital gains or doesn't have to sell capital assets of the fund, i.e., the capital that earns them their NII year after year, in order to pay distributions. This avoids what is called sequencing risk, the risk of having to sell off capital at the wrong time, i.e., when prices are down, thus locking in paper losses, making them permanent losses, because you need the regular income. 2. Equity funds that hold corporate stock are a very different story, and equity investing varies considerably from credit investing. In terms of the types of risks and expectations investors have, historically, a typical equity return has averaged about 9 to 10% over the past century. With equity, that return, which we call total return, consists of two elements: a relatively small NII of maybe 1 or 2%, because the average stock only pays a dividend yield of about 1 to 2%, plus an anticipated average 7 to 8% per annum capital gain. You add them together, and they give you the 9 to 10% total return that we're all looking for. But with only 1 to 2% in NII, the business as usual income, the NII coverage of an equity fund's distribution is often only about 10 or 20%, even less for many after fund expenses are deducted. This is why equity investments have a lot of sequencing risk for retirees or others that need to withdraw funds for retirement or other needs regularly. If markets are down and you need to withdraw funds, having little or no NII means you have no choice but to sell off some of your capital at a loss. So when markets recover, you have less capital invested to participate in the recovery. This means that NII coverage, or earnings coverage as it is called by CEF data, is a fairly meaningless statistic for equity funds, since what differentiates successful equity funds from unsuccessful ones is not their NII, but rather their capital gains. So, how do we determine whether an equity fund's distribution is covered or not? We have to look at total return and compare it to the amount of the distribution. Total return for all funds, not just equity funds, consists of the sum of both the fund's distributions plus its capital gain or loss. For example, if a fund pays out a distribution of 2% and its net asset value increases by 8%, then its total return is 2% plus 8%, or 10%. Not to make things more complicated, but we should remember that closed-end funds have two values that we look at: their market value and their net asset value. The market value is just that, what the shares of the fund sell for in the marketplace. The net asset value is what the fund is worth when valued at what each individual holding's market value is currently, i.e., what the fund would be worth if the fund were liquidated and its assets sold. As long-term holders of funds, we are mostly interested in the net asset value change over time. So we will use examples here that show the total return in terms of NAV change. Most closed-end fund analysts believe a fund's total return on NAV is what fund managers should be judged on, not the total return on market price, which reflects fickle market forces that are outside the fund's control, that may price the fund at a premium or discount to its actual NAV. Most data providers show the total return measured by both the market value change as well as the NAV change, and we report on it both ways when reviewing our various model portfolios. Distribution coverage. For an equity fund, therefore, ignores the fund's NII and simply looks at how much its total return covers its distribution payout. Conceptually, this is incredibly simple. Since total return equals the fund's distribution plus the change in the fund's NAV, up or down, all we have to do is look at the total return for any period of time and compare it with the distribution rate, and we can tell at a glance whether the coverage is above or below 100%. If we see a fund that has a total return averaging, say, 10% per annum over a period of time, and its distribution is 9%, then we know the coverage is 10% divided by 9%, or 110%. The extra 1% in total return would show up as an increase in NAV from one period to the next. But if we see a fund paying out a distribution of 10% and its total return over time is only 9%, then that means the fund's distribution coverage is only 9% divided by 10%, or 90%. In that case, NAV must be eroding by 1% per annum, i.e., a negative capital gain, aka a capital loss, to cover the fact that the fund is overpaying its total return by 1%. Analytical challenges. Both credit funds and equity funds present their own analytical challenges in terms of evaluating distribution coverage. Credit funds tend to pay a spread, i.e., margin, over the risk-free base rate, i.e., the short-term treasury rate or a similar rate. That varies over time with economic and interest rate policies. So 10 to 15 years ago, the Fed started a zero interest rate period that lasted for quite a while, during which a good yield on credit investments might have been in the 6 to 7% range. More recently, it's been up around 10% or even higher for various types of credit securities. So the current distribution levels of many of our credit holdings are well covered by the total returns they have been earning for the past year or so, but would not be if they were only earning the returns of 5 to 10 years ago. Therefore, we will have to watch them closely to monitor their yield coverages going forward as interest rates change. Fortunately, I don't expect yields to return to the super low levels of a decade ago, since current yields are not really all that high compared to the averages of the past 50 years. Equity funds present a different sort of challenge. Here, as we've described up above, the coverage depends on achieving capital gains sufficient to pay the distribution levels. Even healthy equity funds don't always achieve level capital gains month after month. So many equity funds have what they call managed distributions, where they try to cover the distributions over the course of, say, a year by essentially borrowing the returns from the profitable months to support the months that aren't so profitable. This strategy works as long as overall the distributions are covered over the course of a longer period. In other words, as long as the capital gains outweigh the capital losses over the course of the year, or whatever other period they are managing through. This article, link here, explains the managed distributions challenge in more detail. A good example of how all these different elements of coverage can come together in the same fund's analysis is the Cohen and Steers Closed-End Opportunity Fund, FOF, an old favorite of many income factory investors. FOF is a fund of funds that holds dozens of different closed-end funds of various asset classes: loans, bonds, preferred shares, large and small cap equity, utilities, infrastructure, energy, etc. As a result, it generates a reasonable amount of NII from its many credit and fixed income funds. But it also depends on capital gains from all its equity funds. FOF has paid a steady distribution rate of 8.7 cents per month for 15 years and currently yields 7.9%. In assessing its distribution coverage, we first consider its NII coverage. Since FOF is a hybrid fund that holds both credit and equity funds, we would expect it to have some NII coverage as a result of its credit holdings, but nowhere near full NII coverage because it holds so many equity funds. Sure enough, CEF data shows FOF's NII coverage, i.e., earnings coverage, to be 34%. That's far lower than the 100% or more NII coverage of a credit fund like NCDL, but much higher than the typical all-equity fund that might show only a negligible amount of NII coverage, if any. Given that its NII provides only partial coverage, then we'd look at FOF's historical total return to see how well it covers its distribution. Here, FOF shows impressive recent total returns of 10% on NAV and 17% on market price for the past 6-month period, and 27% on NAV and 28% on market price for the past year. This means its recent almost 8% distribution has been covered by 200 to 300% if you look at the past 6 to 12 months total returns. When we look back further, we see the coverage has been somewhat tighter. FOF's average annual total return for the past 5 and 10 years has been about 9%. That has covered its distribution of almost 8% by over 100%. Its NAV total return over 5 to 10 years has averaged about 7% per annum, slightly below its 8% distribution. That suggests some years the fund went ahead and paid the distribution that it appears to be very committed to, even though it may not have been fully earned in that period, at least on an NAV basis. This, too, is not that unusual, in that some fund management are committed to maintaining certain distribution levels and will continue to do so, even if full coverage is lacking. This adds an additional dimension to our analysis, in that the numbers may not always tell the full story, and we often have to try to read the mind and discern the intentions of management, read their commitment to various distribution levels, and willingness to continue funding those levels even if full coverage is not apparent. I do not believe this is a concern re FOF, given how strong its current coverage is, and the apparent management commitment to a distribution level that's held for over 14 years. I use it merely as an interesting illustration of a fund that needs to be assessed from several of the perspectives we described earlier in order to understand its distribution coverage. I continue to view FOF as a very solid fund, although I wouldn't buy it at its current 6.5% premium. I hope this has been useful in shining some light on what can be a tricky concept. This article was written by Bavaria